Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Global Alts Miami by iConnections. And joining me for this segment, we have Bob Elliott, co-founder, CEO, and CIO of Unlimited Funds. We're going to discuss how global alternative investments are leveraged for portfolio diversification. Bob, it is great to have you with us.
Thanks so much for having me.
Welcome to TradeTalks. I've been looking forward to this interview. You put out a tweet, if you don't hate part of your portfolio, you aren't diversified enough. And it kind of seems counterintuitive at first blush, but it does make sense, right? Tell us what you mean by that.
I think in a lot of ways, folks have learned the lesson over the last couple of years of, go long equity risk, and the longer your equity risk, the better off you're going to be. And the reality is, that can do well for periods of time, but it doesn't necessarily mean that over the long term that's going to do well. And part of the whole design of creating a robust portfolio is to have those things that maybe aren't performing well in certain environments, but help improve the portfolio in other environments. And so if you don't have something in your portfolio that's doing poorly, that you hate at any point in time, it means that you don't have the protection were the macroeconomic environment to shift.
Right, and that's why you're seeing this increased demand within the alt space, and moving away perhaps from the traditional 60-40 portfolio is the trend right now. But why do you continue to see this increased momentum in alt, and what are some of those key trends that are driving it?
Yeah, I think a couple of the key trends that I've been seeing, walking around this conference, talking to people, is first of all tailoring alts. So I think in a lot of ways, people might have particular managers or particular allocations that they like, but that's only a small portion of their portfolio. And what they want to do is they want to find tailored products that can complement those portfolios, those existing managers. And so that ability to deliver as an asset manager, a tailored solution, I think is very important for a lot of folks, instead of something that's just off the shelf that doesn't reflect every individual allocator's needs. I think the other thing that I'm seeing across the industry, the question of fees, it always comes up. And in a lot of ways, we are in a world where, the 2 and 20 model is now getting bifurcated. There's a lot of great managers that are out there that are frankly worth a lot more than 2 and 20, and you're seeing them price higher in terms of the fees that they're charging. But the reality is the vast majority of the industry is not worth 2 and 20 fees for the end investor, and so that's creating an interesting bifurcation where you're getting a lot of challengers coming in, lower cost challengers for those funds that maybe aren't worth the 2 and 20 that they're charging.
Financial services, the space in general, whether you're looking at traditional DeFi, alts, it has a way of scaling and perhaps moving the industry in a way that you might not necessarily appreciate as an allocator or a manager, but that's kind of the ethos of the competition within financial services. You also made a good point where it's not a one-size-fits-all solution, and I would also argue because of the technology that's available today, right? It's become more efficient to tailor and include alts within client portfolios.
Right.
It's not just for a specific subset of people.
Right, and I think a lot of allocators, and whether it's sort of true institutional allocators or what I describe as institutional-like allocators, like big RIA aggregators and folks like that, which operate pretty close to institutional levels, what they're looking to do is how do you bring alts into a portfolio, maybe where some portion of your clients aren't accredited, aren't qualified purchasers, might have liquidity needs, things like that. What's out there to do that? There's been a big push from a lot of the big institutional investors around here around things like interval funds or auction funds. Those are beneficial because they give smaller scale investors access to those alternatives, but they have some limitations. They're pretty expensive, they're illiquid, they're still somewhat illiquid, and so a lot of folks that I talk to are interested in how do you improve the liquidity profile. So it's not just about the returns, it's not just about the fees, but the liquidity matters a lot. Right. To a lot of investors. So
you brought up the macro landscape and the impact that it can have on more traditional focused portfolios. Does the macro landscape impact some of these alternative investments as much as it would, let's say, an equity or a bond, number one? And then number two, do you think perhaps with finding more liquidity and finding products that are slicing and dicing these types of products, is it becoming crowded? Are you concerned that the space might become too crowded?
Yeah, I think in answer to your first question, there's a lot of products that have been in the market over the last 15 years that are essentially different ways of repackaging beta and equity risk. And those products, I think people are starting to ask questions about whether the returns that they've seen over the last 10 or 15 years post-global financial crisis is really the type of returns that you're going to see in the future. It's one thing when you're the first private credit issuer.
Right.
It's a little harder when you're the 100th private credit issuer and where you've got trillions of dollars flowing into that space. So a lot of questions there, and in a lot of ways folks looking at how do I get to something that is, instead of being long only, how do I get to something that's a little more agile, a little more flexible? Say the macroeconomic environment turns, who is going to be in a position to be able to absorb that, and even better, generate some positive returns during that sort of environment, and who's basically stuck in the illiquid portfolio that they have. And people are much more, as I talk to folks, looking for those liquid, agile strategies that can go long and short and be diversified.
Yeah, and I think it's important that for the industry itself to be able to educate investors, because sometimes when you hear about these are packaged, you kind of think ETFs, right? And ETFs, they don't trade like SPY or QQQ because the underlying is different. So there kind of is that concern that investors are aware that packaged product doesn't always mean ETF, and these impact your portfolio in a very different way. And then, by the way, alts are one big thing. I mean, there's multiple subcategories
of course.
of alts. I mean, music royalties is one thing, real estate's another, wine
Soccer
is something
teams.
else. Right. I mean, look, at the end of the day, if there's investor demand, they'll figure out a way to package something and put a product out there. But it's, I think just calling something alts or aligning digital assets with that is disingenuous because the subcategories are massive.
Right. And it really is. When I think about the alternative space, you really want to divide it into two different spaces, which is there's products that are primarily long-only products. So, private equity, venture capital, music royalties, things like that, where you're buying an asset and you hope it's a good asset, but you're not trading the asset. And there's a whole different universe of assets which are not long only, right? That can move long and short across different positions, can evolve their positioning based upon the macroeconomic cycle. And those two areas, there's been so much money flowing into the long only in the last 15 years that I think there's a lot of folks who are saying maybe we've gotten over our skis, and in part because they've run into liquidity problems with those long-only products. Venture capital, private equity distributions these days are something like a third of what they were back a decade ago, a third of the pace. If you're an allocator and you're thinking, hey, how do I manage my cash flow, which is a big part of what they're doing. That's a lot. That's a pretty radical change just in the span of a couple of years, getting a third the amount of cash flow. And so, in particular, for those folks who've been burned by the illiquid products, they're really saying, "Hey, look, we got to improve our liquidity profile. We have to find things that are liquid, that are agile, that can move through different points in the cycle." And that's really the demand that we're seeing.
Which is interesting because it's almost counterintuitive in a way. The thesis behind increased IPOs or more M&A activity this year is because of this money that's on the sidelines, and it does have to get moved around. So timing is everything, to your point. So when you think about the outlook for this in 2025 and even looking beyond, do you continue to see more growth in it? Do you continue to see more investors having exposure to it?
Well, I think particularly the last couple of years, if you're an allocator or if you're run an RIA, it's been pretty easy, right? Which is buy the riskiest equities you can possibly buy, and go along for the ride. And we've already seen in the beginning of this year how that may not be the path that we're on here in 2025. Expectations have changed a lot, are much higher. There's a lot more policy uncertainty, both in terms of monetary policy as well as fiscal policy. And those uncertainties are starting to bend the curve, so to speak, in terms of what has been kind of the obvious, just go long stocks and you'll do great trade. And in that environment, we're seeing investors start to think, hey, how do I take a little money off the table on stocks? Where do I find things that maybe are more compelling risk return in a more uncertain environment? And that's really, I think, what's going to characterize 2025.
I kind of alluded to this question before. Let me ask it in a different way. So these policy shifts that we're seeing, are certain sectors within the alternative space either immune to it or because their profiles are so different than what you see in traditional the way equities respond to headlines and so forth. Are they immune or more insulated, or do they react in a different way? Are music royalties, do they really care what's happening in the policy space, right?
Probably music royalties don't so much,
right.
But I think one of the challenges we actually have more than the policies themselves is the uncertainty of the policies.
Right.
And so I think there's clarity around direction. So, certainly there's been indication of, more positive views in the crypto space. Mm-hmm. More deregulation, which and less concern about industry consolidation. Those things, on the surface have positives for those various assets, but those sort of broad strokes views of what the policy is going to be aren't necessarily the nitty gritty that's necessary. So when it comes down to it, like, are we going to allow thousands of coins to be minted on a daily basis, right, in the crypto market, or is someone going to come in and think about that question a little bit?
Execution's very different than indicating what kind of policy you want to have. Right.
Exactly. And so that what we really have, and execution only comes when staff comes, mm-hmm. and staff only comes after people have been, after the leadership has been confirmed. Mm-hmm. And so we've got basically a year of uncertainty when it comes to the actual execution of policy rather than the broad strokes of policy. A lot of the broad strokes have been priced in. Now the question is, when the rubber meets the road, are we going to get the broad strokes everyone hoped for, or is it going to be a little more friction than people expected?
All right, Bob, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from Global Alts. I'm Jill Malandrino, Global Markets Report.